Hello and welcome to week 8 of corporate finance. This is our final week. I know it's been a long course with the holiday break, but we're finally wrapping things up. But just a reminder, by Sunday, Super Bowl Sunday, have your paper, your PowerPoint presentation, final homework submitted in, and I'll have the test out on Thursday. Again, it'll be a little bit shorter test and it'll be multiple choice, so we'll wrap that up. But this week, just look at chapter 19 and 24. Gave you a kind of lengthy mini lecture out there to read through. But chapter 19 looks at that the importance of keeping track of our cash and how we know what our cash situation is. This past week they said Apple has over $96 billion in cash, so it's kind of a nice situation to be in for Apple. But it almost begs the question is, do they have too much cash? Should they be giving some of the money back to their investors in the form of a very high dividend? If they don't have anything to do with that cash, are they not meeting the investor's opportunity cost? So in this chapter, it talks about that short-term financial planning, whether to have a very relaxed strategy where you maybe borrow long-term, don't have to come up with money every day, or you can have a kind of a restrictive strategy that says, hey, I'm going to borrow very short term. My borrowing costs could be lower probably if I borrow short term, but it's kind of like the idea of like going from a 30-year mortgage to a 50-year mortgage. You got to make sure you have that cash available to make the payments. So that's the trade-off. You get lower borrowing cost, but it could be a little bit more concerned if things don't go as well in your business. Last chapter, chapter 24, gives you some exposure to derivatives. Derivatives basically derive their value from some other underlying security. Two main things I want to stress in this chapter to try to manage risk. The idea of using options. Think of an option almost like an insurance policy, the right to buy or sell some underlying security at some price in the future. If you were a farmer, you'd probably buy a put for the right to sell your wheat at a specific price, so that way there'd be no surprises and you know exactly what the price you're going to receive. It's kind of a unique situation because most businesses don't get to know exactly what they're going to sell their price at down the road. It's just kind of whatever goes on the market. The other is a futures, and a future is another way to hedge in the sense, say for the farmer, he would probably bet that the price would go down, that is to go short, and that way if 6 months from now the price did drop, money would be added to his margin account, he would win on that, but he would lose when he go to the market to sell it at the price. Vice versa, if the price does go up, he'd lose on the futures contract, but he would win in the market. And it's not just wheat. This could be on anything. It could be from a currency. It could be to a professional money manager trying to hedge against the changes in the S&P 500. So, well, I want to keep the mini lecture brief to week. I want to say I have enjoyed working with everyone. I hope the videos were a bonus, a little bit to help the course out. So, do, again, email me if you have any questions, but we have 1 week left, and we'll wrap it up with that. Have a great week.